Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken. Our model portfolio is up year to date 0.96%. We have a green for the stock market strength color signal as of February 17th, 2024. And the portfolio we try to beat here is the S&P 500 buy and hold investor. They are up 5.09% year to date. So we are not accomplishing our goal, and that is why ours is in red and theirs is in black. Our portfolio, we just do a simple portfolio at SPY Trader Now. We just do a 3-position portfolio. We either have shares of the ETF symbol SPY, which represents the S&P 500 or the stock market in general, or we do options, and we do everything. We buy, we sell, and we do everything with SPY options, and we also have cash. Currently, you can see our portfolio, how it's broken down on a percentage basis and on a cash basis of where we currently stand. Here are some past returns for the model portfolio. In 2023, we returned 14%, and we did not beat the S&P 500. They returned 24%. In 2022, we did in a very good 21%, whereas the S&P 500 was down 19%. And in 2021, we had a return of 78% as compared to 28% for the buy and hold investor. Right now, the S&P 500 for the last week has lost 0.34% for the week. We'll go over the graphs in great detail later on in the presentation. I did make a trade last week. I did buy to open one long call, and the exact call I bought is right here, and we'll go through that at the end of the presentation. Now here are all the trades we've made so far in 2024. There are 3 open positions. That's why they're in yellow. The first one is we hold 200 shares of SPY, and our purchase price is right here, and the current trading price is here, so we have a profit of about 2,300. Now, on this covered call, which means we sold 2 contracts, which equals 200 shares of SPY, and we have a strike price of 465. So obviously we are in the money, and we sold it in the money, and that is why it's represented here as a negative number. So that's what that is. And then we also have a long call. So our long call, we've had a purchase price of $17.28. It's currently trading at $18.13, so we're up $84. So that's just to put a little bit of skin in the game on this, because this market is just so strong. I hope, if you have not done so already, go ahead and hit that subscribe button to follow this portfolio along throughout 2024. Ring that bell to be notified when I post a new video, and help me and smash that like button down for me right now. Thank you. Here is the equity curve of our model portfolio for 2024 year to date. Here's the equity curve of the buy and hold investor for year to date 2024. And here are the 2 equity curves combined, because it is so very important to compare whatever the heck you're doing to a benchmark. In our case, the benchmark is the S&P 500 buy and hold investor. And this is how we compare. Now, we're only up 1%. They're up 5%. So far, this strategy, I've been way too conservative, and we are down 4 percentage points so far this calendar year. Our goal is to turn that around so that we are on top by the end of this calendar year. All right, here is the Fed Chair, Jerome Powell. Now, the next announcement will be on March 20th. And what is the Fed going to do? Is he going to do a 25 basis point rate hike, a cut, or skip? all options are on the table. Now, him doing a rate hike is highly unlikely. The market wanted a cut, but the way that the data is coming in with hotter than expected inflationary readings, he's probably going to do a skip. And he originally said he's going to do 3 rate cuts in 2024, and he said that in 2023. Now, as the closer he gets to the election in November, he's going to be frozen. He can't, politically, he should not make changes to affect the election outcome. So, which means he only has a few months left, at the very most July. And probably even, yeah, I would say after, from the July announcement, September, he's probably not going to do anything here. So only these next 3 announcements at the maximum, and maybe only these 2, he can really do something. And the data is coming in hotter than expected. So it does not look like, I'm not sure. I doubt we're going to get 3 rate cuts in 2024. I doubt it. That's just my expectation, unless he pushes off that last one to December and does one in March and another one in May or June. But he really can't do March. The data is not supporting that thesis. So we'll see what happens. Now we're looking at things from the presidential election cycle theory, which states that depending upon the year of the election, you have historical rates of return for the S&P 500 and for the NASDAQ 100. Currently, President Biden is in his 4th year, 2024. Historically, the S&P 500 averages 6.7% of a return on that 4th year of an election year. Now, currently, the market is up 5.09%. Well, that's only 1.7%. Very close to the historical averages at this early stage of the year. So it kind of tells me there's going to be a lot of turmoil with the market going up and coming down and going up and coming down throughout the year. How exactly this is all going to play out is yet to be seen, but we are definitely going to have a minimum 10 to 15% correction at some point in this calendar year. Then I expect it to recover before the end of the year. This is my personal expectations, but we'll see. Okay, now we're looking at things from the bond market outlook. The bond market is saying stay out of the stock market because you have an inverted yield curve and you have rising interest rates. So currently, what we have is on the 10-year 4.31. Now that jumped from 4.09 to 4.31, so that came up, whereas the 91 or the 3-month yield did not budge, 5.23, 5.23. So that's it. We're waiting for this correction to go back to normal, and that's one of the reasons why I'm definitely a little bit timid on my going fully invested, is because of the way that this market looks. Okay, now there's our friend Warren Buffett, the Oracle of Omaha. We are in, and this is CNN Business Fear and Greed Index. We are in extreme greed. Last week, extreme greed. This week, extreme greed, although tapered very little. So we want to be cautious at this juncture. Now we're looking at things from a seasonality outlook. Currently, for the month of February, we are up 3.44%. Historically, over the last 20 years, for the month of February, 60% of the time, you're going to close the month higher than when you opened the month. We have already accomplished that goal, and we're up 3.44%. So we have room to spare to come down and still be positive for the month. Keep it now. Today's the 19th. Well, as I'm recording this, it's the 19th, and then trading is closed today. Trading will be open tomorrow on the 20th. Okay, so now we're looking at a 20-year monthly chart, S&P 500 long bull run, and we're still in it. There was a correction. We broke out of that correction here, and we never looked back, and we're still not looking back. This market is moving forward. MACD is doing really well, where it's gaining distance between itself and the signal line. Slow stochastics is above 80 and bouncing around. All of these things are bullish conditions, long-term bullish conditions. So we might have some short-term wigglies, but overall, that's a long-term bull market, and we're still in it. Now we're looking at an intermediate term outlook, 5-year weekly candlestick chart. And you can see the incredible run from here to here. This is just with one down week out of all these weeks. And so far this week, two down weeks. Last week was a down week, but I mean, it is so close to the top that, but it's still a red candle, fine. Look at all the green candles with 2 red candles. This is very, very strong. All right, now 6-month chart, daily chart, candlestick. We are in this trading pattern, and until we break one way or the other, we're going to continue to stay on this trajectory. Now we are looking at a ratio chart of the NASDAQ 100 compared to the S&P 500, and normally in bull markets, you want the NASDAQ 100 to be leading the S&P 500. And then that's good for both markets, both the NASDAQ and the S&P 500. Right now, the NASDAQ is coming down, and this is the 50-day moving average on this daily chart. And a lot of times when you're at the 50, you find some level of support. Sometimes you come through it, and then you come down to this lower support line here. So we're either going to find support here, or the expected support would be here before we bounce and NASDAQ starts to pick up and the market as a whole starts to pick up. But we're still in this trading channel, and this trading channel is traveling north. Both of these indexes are doing good. All right, now looking at another ratio chart of the equally weighted S&P 500 compared to the normally cap-weighted S&P 500. The ratio chart is in black and red. The equally weighted lime green. The normally cap-weighted is in dark blue. Now, this is going back 20 years, folks, weekly chart. In 3 times in 20 years has the ratio chart fallen off of a cliff. Fell off a cliff here, fell off a cliff here, fell off a cliff here. The 2 previous times, if you look at the normally weighted S&P 500 in dark blue, you fell off a cliff here and you fell off a cliff here. Now, the ratio chart fell off of a cliff. The market did have a correction way after the ratio chart dropped off of a cliff. Now, keep in mind, when they fell at the exact same time as the ratio chart. If you look at the way the chart lines up, it fell exactly. When this ratio chart fell on this line right here, the S&P equally weighted and normally weighted did not drop. There was a small correction from here to here, but it's already going up. So are we actually going to miss the falling off of a cliff with the ratio chart falling off of a cliff with 20 years of data? This is, with an inverted yield curve, this is unbelievable that the market has done this. This is one of the reasons why I have also been very cautious in my trading and how much leverage I have on trades, because we haven't fallen off of a cliff. These are good 20 to 30% corrections, and I don't want to be caught in a 20 to 30% correction in a long position. So, but the market's not doing it. It's not looking back. I guess this AI technology is just pumping this market up. All right, now we're looking at the fear index, which is also known as the VIX or the volatility index. There are 3 ranges: the ultra low range, the low range, and then this upper range. This is the S&P 500 in dark blue. Well, we did spike up last week, and the market did have a small drop, but boy, it's still in this upward trajectory. It hasn't broken that trend line right there. So the VIX quickly tucked its tail or its head back in its shell and came back down in the ultra low range. This market will continue to advance, as long as we are in the ultra low range. Keep in mind, I did take on one long call to help participate in this ultra low range and market advancing. All right, now we're looking at the Thinkorswim platform on a 5-year weekly chart. And here we have standard deviations. Here's a little bit of information about standard deviations if you don't know it. And here's the +2, -2, +1, -1 in pink. And we are currently traveling north and we have not reached the +1 yet. We are at 0.5 on this 5-year weekly chart, giving plenty of time and room to continue to advance before the probabilities suggest you correct otherwise. Now we're looking at the same chart but going back 1 year, and this is daily. And on this chart, you're almost at the +1. You're at 0.9 standard deviation. And the longer you stay above the regression line, which is in dashed green, the standard deviation lines will slowly pump higher, higher, and higher. So the market can continue to advance with the standard deviation of 0.9 or in that range. All right, now we are looking at the same chart, but instead of going back 1 year, we're only going back 6 months. And here we've got the sell zone and the buy zone. Our standard deviation is at 0.5, plenty of room to continue in either direction. But we have not broken, we're making higher highs and we're making higher lows. What does that tell you? You have an advancing market. So until we start making lower highs and lower lows, this market is still advancing in this trajectory. Now, here is where I'm putting a spreadsheet together where I'm doing a bunch of different asset classes, and you can read exactly which asset classes I'm talking about. And also the 11 S&P 500 sectors are all broken down per sector. And I want to get an idea of how the strength is. And this is how you get where I'm getting the data, what I'm doing. So we'll use this line as an example. So for the S&P 500, the slope of the 50-day simple moving average over the last 1 month is, and if that slope is 0 for negative, 1 for flat or within 1%, and 2 for positive if it's over 1%. So on this one here, the slope of the 50-day is positive and it is greater than 1%, so it gets a 2. This one here, the slope of the standard deviation lines on the 6-month chart is that 0 for negative, 1 for flat, and 2 for positive. And we break that down here. Then we do the trading above or below the 50 simple day moving average. We are above, then it gets a 2. So then we sum all that up together and the asset class strength is 6. And then we come down and we add all this up together and we get a total. Now the total is 79%. Now, depending upon what that percentage total is, will determine what this color guard signal is representing. Now, in our case, 79% is between 61% and 100%, so we're going to give it a green. So that's how I derive at the information. Now, and I also want to determine how we compare to last week. Last week we were at 79, this week we're at 79. Last week the 11 sectors were at 79, this week we are at 86, indicating more strength during the previous week across all 11 sectors than the previous week. So that's telling me more strength in this market. Now we are looking at a 1-year chart for the 10-year bond yields. That is the candlestick chart here. There was a trading range. We were at support on this dash blue. We were at resistance on the solid green. We broke out above this resistance line that stopped us the previous time here, and we broke out above it. We came up, came back, touched the support line. Well, the resistance line, but now acts as support because you're on the other side. Touched this line here, now it's acting as support, bounced up here. Well, if this stays up here, out of this trading range, and if it continues to go higher, well, those higher yields will eventually affect the stock market, and it will come down because the market it's not enticing to invest in the market when you have higher yields. On Monday, February 19th, trading is closed. I'm actually recording this on Monday, so I'll get this video posted today. But as everybody should know by now, especially if you're a trader, you already know this. The market's closed, and it says for Washington's birthday, but I think they call it President's Day now. Okay, I have just given you a ton of information in this video. What are you going to do with that information? Now comes our critical thinking. Well, as of February 17th, 2024, the market summation, according to me, your friendly host with SPY Trader Now, the market has been strong. The market is strong. I have been too conservative. I admit I've been too conservative. I don't want to lose money. My fear is losing money, and I've been too fearful. That's why my portfolio, the returns have not been there. And I have FOMO, fear of missing out. But my discipline will have me stay the course with my positions because I know I'm going to have a 10 to 15% correction at some point in 2024. I feel very confident about that. My in-the-money covered call at that point in time I'll be able to collect at that point in time because that in-the-money covered call will lose money. My portfolio will make money while the S&P 500 is losing money. Now you can watch me throughout the year to see how I play that out. Now the market action did allow me to put on a long call, and now we're going to wait and watch and see that market action. And the long call that I put on, this was my trade alert that I sent out, and this is the one that I told you I was thinking about doing last week. Well, I actually did the exact same trade. You can see it right there. I hope this was a valuable video for you to watch. If you have not done so already, hit that subscribe button, ring that bell. Do me a 100% solid and hit that like button down for me, please. I thank you, and I wish you good trading.